What's interesting in this space is credit insurance is often used as a financing tool in the tooling sector, more so than a risk management tool. The reason here, there's a couple of reasons, but chief amongst them is capital. Tooling is exceptionally capital intensive. In the case of making larger molds or die sets, it can take anywhere from 12 to 18 months to make that piece of metal, to cut that metal. So that ties up a lot of capital as you're buying that initial hunk of metal, as you're paying your labor, you're paying for the amortization of your machine time, electricity. So you're starting off, let's say, with $1 million hunk of steel, investing $1 million of variable cost in it over the span of a year, all the time when potentially not getting down payments or progress payments. So leveraging credit insurance on the risk of contract cancellation, which brings in coverage for work in progress inventory, provides a lot of support to banks. So banks will increase how much they will margin on work in process inventory, finished goods, or unbilled contracts receivable because of the insurance that can be attached to it.